This is the Value Investor Podcast with Tracey Reineck. All things value, all the time.
Welcome back, value investors. So stocks have been a little weak to end 2024 and to start 2025. A lot of uncertainty out there as the Trump administration comes in, and nobody's really sure what's going to happen, if tariffs are going to be put on, if there's going to be a lot of deportations of undocumented workers. A host of things could happen. And so the market hates uncertainty, and so it's kind of on hold, waiting to see what might develop over the next, couple of months here. But while it's a little weak to end 2024 and start 2025, that means some stocks have gone on sale. And I've been watching a list of my favorite stocks, many of which have gone on sale, some of which are down 20% in just the last couple of months now. That's a bear market. And so I began to wonder, are these values or are these traps? Are there any deals in these stocks that have pulled back quite a bit from their highs? And so I just made a list. I didn't run a screen on this, although I could have run a screen for maybe stocks trading, near their 52-week low or something like that. But these stocks aren't really near 52-week lows in many cases. They're just off of their highs. And so that has created a buying opportunity. Although I have at least one or two of these out of the five I'm going to talk about that are actually near 52-week lows. So that's pretty dramatic given the huge rally that we did see in stocks last year. So what are these? This is a mixture of stocks in some areas that you might assume could be cheap right now, but that are having a little bit more troubles because the 10-year Treasury has continued to rise instead of fall while the Fed has been cutting its interest rates. And that would be in the home, housing industry area. That includes some like construction firms, the home builders, furniture retailers, but not all, but many of the furniture retailers. Another area that has been a little bit weak is in retail, even though many of them are reporting very good earnings and like outlooks for the holiday. Nobody has really come out and said, oh, sorry, we missed that, holiday stunk. It's the reverse. Many are coming out and saying, hey, holiday was pretty darn good as we expected. So the consumer is still spending. We've heard from a couple of the big banks now already on earnings. They are still showing consumer spending up year over year, quite strongly, in fact. So despite everybody saying that the consumer is going to finally slow down, we're not really seeing that. Another area I took a look at, but I'm going to cover it on a different podcast, and that is, of course, tech, especially on the chips. Some of those have been pulled back. They've done this all throughout 2024, but I'm going to stay on the sidelines with some of those, so I'm not covering those in this podcast. But I took a look at some of the drug stocks. A lot of them have had a nice pullbacks. Are those values or traps? And one staffing company I'm going to take a look at as well, because that one is trading near its 5-year lows. And I think we've covered it on the podcast. I know we have, but it might have been several years ago was the last time we might have covered that stock. So let's dive right in. And we're going to start with the home builders. We could have picked any number of the big cap home builders because many of them are in bear market territory, down 20% or more off of their recent highs. I went with Pulte Group, ticker PHM. I own it in the Zacks Value Investor portfolio. It's the largest publicly traded home builder. I think they're in 29 states. So they're pretty much countrywide, so they will give us a good idea of what's going on. They don't report until January 30th, so you might want to tune in to kind of see what's going on there. Over the last 3 months, the shares are down 20.1%, so about 20% off of their highs. And so that has created a buying opportunity, but is it one? So Pulte is cheap on a PE basis. It's been cheap for a while. It's trading with a PE of just 8.4. It has a PEG ratio of 0.45. So both of those are really, really cheap. What's going on with the actual earnings estimates? So the key thing with the home builders is everybody is worried about the margins now, because as long as those mortgage rates stay elevated and above 7, the home builders have to pay more to buy those rates down, and many more buyers stay on the sidelines as well. So they're paying more to buy it down. So that's expensive. That'll go to the margins. So instead of having 29% margin, if more of the buyers are doing the rate buy down thing, that is considered an incentive by the builder, then maybe their margins go down to 27.5. That will impact the earnings. Many are expecting possibly a decline in earnings here for 2025 as those margins come down off the highs. We basically had kind of, as far as the margins were concerned, a Goldilocks environment for the home builders last year in 2024. Yes, mortgage rates remained fairly elevated, but they did come back down into the 6s for a while. And so that made it cheaper to buy down those mortgage rates. And so their margins managed to remain somewhat elevated. Inventory rose in certain key markets for existing homes, but not in all. And it only kind of spiked towards the end of the year after the spring season. So the home builders still had an advantage and were still able to get a lot of the buyers in to look at their homes versus the existing, because there were no existing on the market. But that's changed in a lot of markets, especially where the home builders are. I would say in Texas, especially in Austin. But some of the home builders, like Toll Brothers said, they saw a rebound in the Houston market, even though there's still weakness in, say, San Antonio and Austin, but Dallas trending a little bit better as well. There's a lot of inventory on the market in Dallas area now, though, so that is going to play a factor in the home builder stocks going forward. So what about Pulte? Is it a value or a trap here? Down 20% with the PE of just 8.4. Well, I do like having that PEG ratio, so I know the earnings aren't terrible, but we are expecting now to have a decline in earnings for 2025, but not by much, just 0.3%. So the current Zacks estimate is at 1339. 2024 expected to be 1343. So just a few cents difference there. But that has been coming down a bit in the last 90 days as these mortgage rates have gone ever higher. I think they were at like 7.25 the other day. So that's a lot for them to buy it down all the way down to, say, 4.99. I've seen that promotion from some of the builders, or even 4.25. And so that's going to cost them more. But this is a slow season. We haven't really gotten into the spring season yet, but it is fast approaching. A lot of us think it really starts in the new year now, but we still have the old barometer of after the Super Bowl. But somewhere in here is where it starts to start, depending on the weather. The better the weather, the more likely you are to go out and want to buy a home. And I caveat all this by saying now we have the fires out in Los Angeles, so it's unclear what's going to happen with the entire home market out in Southern California, both new and existing. But there is going to be demand for homes out there. And remember, for Florida, its main buying season really starts in November and goes through March. And a lot of that is because of the snowbirds coming down. They're on vacation in Florida and they're deciding, yeah, maybe I really do want to buy a house. And that's when they're down there. So they'll go to the sales centers during this time of year. So I haven't been hearing too much about what's going on in Florida right now, but again, we're going to hear from Pulte at the end of January here. So I'm going to be tuning in to see, what they're seeing down there. So Pulte, it's a Zacks number 3 right now because we're waiting on those earnings. It is an A for value, but with those earnings expected maybe decline a little bit here in 2025, it does have some value trappiness. I'm just not sure they really are going to decline for the entire year at least. They are going to maybe here for a quarter or two, but if those mortgage rates come back down to say like 6.5, 6.25 eventually by the end of the year, then their margins should still look pretty good. Again, as long as some other factors like the job market remain pretty strong and buoyant, then people will buy homes. So a lot of factors with the home builders. It is cheap. All of them are cheap right here. I don't think we're done with this cycle. Still plenty of baby boomers who want to buy. And so they're buying in, like a Pulte 55 and older community. And then you have the first time buyers that are still buying. They are still able to get in, especially with the mortgage rate buy down. So that's Pulte, little bit of trappiness, but still a value, ticker PHM for Pulte. Okay, then we're going to switch over to retail. I also own this next name in the value investor portfolio, and I also own it in my own. It's Abercrombie and Fitch, ticker A, N as in Nancy, F as in Frank. ANF. It's a Zacks number 1. It's got a B for value. It is still cheap. It was cheap when I bought it for Zacks Value Investor last year, and it remains so because over the last 3 months, shares are now down 18.7%. So this is a little bit of a buying opportunity here. PE of 12.4. They did just attend a retail conference where they gave quarterly update on this holiday quarter, which doesn't end, I think, for another 2 weeks, but they gave, some update on their guidance for this quarter, and many were expecting it to be even better than it was, even though it was still good. So the shares plunged down. So I do consider this to be a buying opportunity in Abercrombie. It's still one of the top retail names. They still had a great holiday. It's still cheap at 12 times, but is it like trappy here? What is supposed to happen for next year? So looking at this fiscal year, which hasn't ended yet, earnings up 69%. That was the great story that's being priced in at 1064, supposed to make 1064. But in the last week, since they attended this retail conference and gave this guidance, 3 estimates are up and 1 is down because they did tweak with the guidance. But the estimate is up a penny in the last week. So nobody's really slashing this year very much here. Next year, next fiscal year, another gain of 5.7% on earnings up to 1125. So 1064 expected now for this year, 1125 for next year. 3 are higher again, 1 is lower again, but the estimate is going in the right direction. 90 days ago, fiscal 2026 was at 1038, and now it's at 1125. So if the stock was expensive, it was trading at a PE of 40 or even a PE of 30, you might be like, meh, that's not that great of growth, or, it's just not keeping as much momentum as it's had the last 2 years, but it's not. It's cheap. It's trading at 12 times, like I said. So that's why I like it. I would be buying here on this pullback. It's a value, not a trap here. And they still are on trend, and even older shoppers up to their early 40s are now shopping at Abercrombie, and I like that expansion in their customer base. So this is a good one, Abercrombie and Fitch, ticker ANF. Staying on retail, I've been watching the furniture retailers because many of them, but not all, have gotten hammered in the sell-off at the end of the year and the rise in mortgage rates. Because if home sales decline, which they are or tend to do when mortgage rates are rising this dramatically, then you don't buy as much furniture. It's so highly correlated, and you don't really think about it that way. But when was the last time you bought a new couch? Well, it usually is when you buy a new home or you're moving into one, even as a renter. You're gonna go out there and you're gonna get something new because maybe it's the wrong color or it just doesn't fit the space the same. And you had it for 10 or 15 years and it's kind of nasty now. So you need something new. We had a lot of couch buying during the pandemic, though, so that really pulled a lot of sales forward, and now not as many people need it, and they're not moving as much. So Haverty Furniture is the one I wanted to look at today. Ticker H as in Harry, V as in Victor, T, HVT. It doesn't get as much play as some of the other publicly traded furniture retailers, but it has a bunch of stores in the Southeast. You would know it if you live there, because it's been around for like 75 years. So very established furniture retailer. It's kind of on par, I would say, with some of the other upscale names like Ethan Allen and those. It is cheap right now, PE of just 11.8. And these shares have been getting hammered. 3 months, though, they're down 14.2. I should look and see if I want to say this one might be around like a 5-year low. It's been like sinking with every tick up in those mortgage rates. It hasn't been good. Wait, I'm looking. No, it's not. It's not back even close to the pandemic lows, but it is, I would say, at a 3-year low here now. So this could be a buying opportunity. PEG is at 0.98. So just right under the 1 level, which indicates growth in value. So I'm liking that. That's pretty cheap. But earnings have been on the decline the last several years, which is why the stock has done the same, because the sales have dramatically declined. So if you check in with Haverty on its earnings, they keep saying, conditions are challenging. We're managing it. We're getting ready for when we come out of this. And there was hope last quarter when they reported that the Fed cutting would finally be kind of the bottom in the furniture cycle, because home sales would pick up when those mortgage rates got cheaper. But now the mortgage rates haven't gotten cheap. So the recovery in some of these furniture names might be delayed a bit. And so these ones that are less known, like Haverty, are still kind of struggling down there. But it gives you an opportunity perhaps to, get into a name like this, especially if things are going to turn around. So for 2024, they're expected to make 93 cents. That's down 71% from 2023 when they made $3.25. That's the struggle right there. But they continue to open up new stores and remodeling. And so they're staying in the game with good product and newness and all that they know they're going to need for when things do start to pick up. And they always do. So right now, the analysts believe it's going to be 2025 because they have $1.87 for 2025. That's 100% gain on the earnings side. Revenue, they expect to be up 5.4% for 2025. But that's after a decline of 16% in 2024. So finally, maybe it's bottomed and moving in the right direction. But we'll see when they report fourth quarter in February. So we're going to have to wait a little bit. Now, Haverty's, again, has been around forever. They have very good management, and they are very shareholder friendly because they've been around forever. So they have good free cash flows, and they have been paying it out as a dividend. But you can see the dividend right now is $1.28 a share, but they were only expecting to make, what did I say, 98 cents or something? So they are, in the deficit right there. And normally that would make me nervous, but with the rebound coming up, And the good free cash flows, I still expect this dividend to remain kind of elevated. That doesn't mean it won't go lower, but we'll see as we move forward here. It's yielding 5.8% though here. Another one that is also in the high dividend area is Ethan Allen. And that one also is over 5% right here as well. Those shares aren't down quite as much. I'm looking to see, I want to say I've written about Havertys as a bear of the day recently in November. That was the last time I wrote about it as a bear of the day here at Sachs. And I still like the company, as I mentioned, but it's just in this industry-wide slowdown right now. And yeah, I do remember as of September 30th, 2024, it had no debt outstanding. And it did have cash and cash equivalents of $127 million. That quarter, it paid $15.3 million in cash dividends, and it's paid a cash dividend every year since 1935. That doesn't mean they won't cut it, as I said, but they do have enough cash on the books there to pay this dividend out without slashing it at all. But it will be helpful if business turns around right now, in the next quarter or two, which the analysts do expect. So is this a buy here? Is this a value? Is this trap? It doesn't look like a trap because this turnaround is expected to happen. So I still like the furniture retailers for that reason. This is one of the cheaper ones because it's just a little less known than, say, Williams & Sonoma, Ethan Allen, RH, which all trade with much higher valuations. And in the case of Williams & Sonoma, which I used to own in the value investor portfolio a couple of years ago, it's just kind of now out of reach as it keeps hitting new highs on the hope trade for 2025, that housing is finally going to start to turn around. So if you're looking for furniture, you don't want to overpay with Williams & Sonoma. Keep Haverty on your list. You do, for now, get that nice dividend. It might not pay that out forever, however, but that's Haverty, ticker H as in Harry, V as in Victor, T as in Tom. Okay, we're going to switch over to drugs now. And this next company is one that normally we might not cover on the Value Investor podcast, but it's now fallen 21% over the last 6 months. And the last 3 months, it's down 18.3%. And this is Eli Lilly, ticker LLY. And last year, about middle of the summer or so, when all the weight loss drugs were super hot and the stock was soaring, it was trading around 80 or 90 times forward earnings. Now, were those earnings on the increase? Yes, they were. But now it looks like the surge in the revenue from the weight loss drugs is mostly priced in. And so the shares are coming a little bit back down to earth. I own it in my own personal portfolio, and I've been waiting for them to get cheaper to add to my position again. So the reason I wanted to talk about it is because, like I said, the forward PE last year was around 80 or 90 times, and now it's at 31 times. So while that's not a classic value stock by any means, it's much cheaper here. So on this podcast, I just wanted to talk about whether or not there is some value in it now at 31 times. Maybe this does go cheaper and we're able to get it at 25 times. That would be a pretty good price, I feel. But let's look at those detailed estimates to see, is there some trappiness here? Why is it off so much in the last couple months? Was it just valuation? They did come out at a conference recently and say that, they gave some new guidelines for the weight loss revenue and everything. And while it was still good, it wasn't quite as hot as what the street was expecting, because they expect the world now, if you're going to pay 80 times earnings, you're expecting to see some huge gains in, earnings and revenue. And while it's still there, it wasn't quite as hot. So the shares have come down. But let's take a look at what is happening now in 2025 with earnings. So 2024, they're expected to make $13.12. That's up 107% on earnings from $6.32 in 2023. That's the weight loss drug right there. But Eli Lilly isn't only weight loss. They have Alzheimer's and other things also going on. So 2025 expected to be up 82.4% again to 23.94. So 13.12 expected 2024, 23.94 for this year, 2025. We don't have any estimates higher in the last 7 days. One is lower, but otherwise everyone else has just kind of been adjusting their estimates. I do have to say in the last 7 days, it has gone down to 23.94, as I mentioned, from 24.03. So 9 cents it's fallen. But again, the rate of growth is going to slow now with some of these big pharma weight loss makers. But still, revenue expected to be up 32.6% in 2025, as it was up 33.2% in 2024. That's also expected. They report actual earnings on February 6th. So if you're listening to this podcast before February, they haven't reported yet, but they have already kind of filled in the street on like what their numbers are looking like. They do pay a dividend, but because of the surge in the stock, it's only yielding 0.7%. So this is one of the drug companies you're buying, really not for the dividend, you are buying it for the growth. So is this a value or is this a trap? Well, considering where it was just 6 months ago, I would consider this to be more on the value side. It's looking pretty attractive here. And if it were to weaken further, even, of course, us value investors, we get greedy. I would love to see it in the sixes. If it got into the 600 range, then even cheaper, and maybe we get that PE into the 20 times. And for that earnings growth, I would say that is value there. And we have the earnings expected to grow next year. So I wouldn't consider this to be a trap at all, but it is finally coming down from its sky high valuations, which us value investors know usually stocks cannot hold those really, really high levels for very long. There are always exceptions to the rule, but usually there is an opportunity to get it much cheaper, and Eli Lilly's looking like this is one of them. So that's Eli Lilly, ticker LLY. And then we're going to wrap up with the staffing company that's at 5-year lows. I used to own this in the Value Investor because the staffing companies for medical staffing soared during the pandemic, as you might expect. Their revenue, earnings all hit new records because hospitals were willing to pay whatever it took to get nurses in during the pandemic. And travel nurses made new record highs in, their rates. And that went to a company like AMN Healthcare Services, ticker A as in Adam, M as in Mary, N as in Nancy, AMN Healthcare Services. Okay, so I do like the staffing side. There is still a shortage in medical personnel, employees, and as those baby boomers continue to retire, but they're also aging, there is more demand for CNAs, for the nurses, for doctors. All of this isn't going to solve itself overnight. But the rates on, say, like travel nurses, as I mentioned earlier, have come way down. The demand has fallen, and they're no longer at sky-high record levels. So the earnings for AMN have just continued to decline over the last 3 years now. So earnings... So just looking back for 2021, this was, basically the height of the pandemic. Earnings were up 134% 2022, we still had pretty strong demand, earnings up 48%. Then by 2023, pandemic was winding down. Those rates started to come down, and so did earnings. It was expected, but still earnings down 31%. 2023, 2024, it was not good last year. They kept coming down. Now, the company itself thought, we've been through the worst of it. They kept saying, like, we think this might be the worst of the decline and it should stabilize here. But every quarter went by and it still didn't really stabilize. Still down, down, down. So until it actually bottoms, these shares, weren't going to go anywhere. So 2024 expected earnings to decline 62% again. But even here in 2025, expected to decline another 54%. So maybe it hasn't bottomed yet. It is a Zacks number 5 strong sell right now. It hasn't reported yet, not reporting until late February. So we still have quite a number of weeks before we hear anything. But just taking a look, 2024 now expected to make 307. But it made 821 in 2023. 2025 expected to make, this is heartbreaking, $1.41. $1.41 after 307 in 2024. So that is, like I said, 54% decline, very dramatic. The estimates are still being cut. That's why it says 2. 2 estimates. This is a smaller cap company, so we don't have a lot of estimates. 2 were cut in the last 30 days. None were raised, obviously. But 90 days ago, analysts still thought we might make 326, which would be a gain on earnings finally for 2025. But alas, no, the company's not seeing it yet. So we're at 141. Very dramatic turnaround here. So is this a trap? It's trading at 18 times because of this decline now in the earnings, even though the shares are at new 5-year lows, lower than the pandemic here. And that says a lot. But 6 months, shares are down 49%. 3 months, still down 36.8. It's still just down, down, down. It's kind of catching a falling knife here. But 18 times, that's not real cheap. But you see this with stocks where the earnings are getting crushed. And even though the stock is declining and at these lows, it doesn't matter because the earnings still are not, they're not good enough to make it a low PE here. So unfortunately, this is not a value. It is a trap here until we get some kind of better outlook on either this year's earnings or maybe next year's. We're going to have to wait maybe until 2026 to finally see the bottom here, to see these earnings turn around on this medical staffing company. But that's just, you're basically sitting in dead money, no dividend paid out here. They used to be when they had a lot of free cash flow, I think, buying shares. I don't think that they are doing that right now, but I'd have to check. I will tune in to the next earnings report just to see if maybe there's any hope there that things are going to turn around. But they will eventually. It will find itself. But this just kind of goes to show you that when you have a huge bull market in an area like this one was in, caused by the pandemic, and it really caused those rates on like travel nurses to soar, that it does take several years, multiple years to have it unwind and return back to, what I guess you would call a normal market. That being said, there is still a labor shortage on all of medical staffing, and it's exacerbated by the baby boomers retiring, as I mentioned, and then the baby boomers actually need more care, and there's more of them. So it's kind of double-edged there. So things will eventually turn around for all of these medical staffing type of firms, but it's just not quite there yet. So I keep it on my watch list because it is a trap here, and I will see. You're never going to time it perfect. There will be one of these reports where they're like, we're seeing a change and we're coming out of it, and yay, we think this is going to sustain. And then the stock will get a boost and will start going the other way. You might miss that bottom if you're waiting, but I just don't see any reason to be in it right now with, the analysts still cutting as recently as 30 days ago and dramatically cutting. So that's AMN Healthcare. I wish I had better news on it, but I'm on the sidelines just watching for an entry point when it finally gets close or closer to the bottom here. So that's AMN. So you can see it's quite a mixture of companies. Some are true classic value stocks with those PEs. Others are not, but they've sold off enough to make them on sale. So that makes it interesting to those of us in the value arena. As you know, I do believe that value investors should own stocks that are not just classic value stocks. There is a place for growth too. And if you can get growth on sale, why not? Why wouldn't I want to do that? So I like to look at some of those growthy names like Eli Lilly. I like to own them like Eli Lilly in my own portfolio. But if I can get a combination of both growth and the classic value like Abercrombie and Fitch, more the better. Those also are very good deals. And, I love uncovering those. So, maybe I'll be doing a podcast on the PEG ratio coming up. We haven't done one of those in a while, and that's both growth and value. But I'm going to kind of wait to see as earnings season rolls on, because I would include the Zacks rank with that podcast. And the rank will change a lot during earnings season. And so I want to make sure we get fresh ranks after these earnings reports come out, because a lot is going to change, especially, if it's good, better than expected, or if we see something like, we've seen so far with AMN Healthcare that, things aren't improving. But I'm hopeful maybe on some of these furniture retailers like Haverty that maybe the worst is over with them, and they're going to talk about it in some upcoming earnings reports. I'm just not sure it's going to be on this next one, but hopefully we're coming out of the woods a little bit on housing by the summer. So let me recap those tickers again. Speaking of housing, we had Pulte Group, ticker P as in Paul, H as in Harry, M as in Mary, PHM. We had Abercrombie and Fitch, the retailer, ticker A as in Adam, N as in Nancy, F as in Frank. It is a Zacks #1 rank, strong buy right now. Then we had Haverty. That's the furniture in the Southeast, ticker H as in Harry, V as in Victor, T as in Tom. It's a Zacks 3 hold right now. Then we had Eli Lilly, ticker L as in Larry, L as in Larry, Y. It is the most expensive on a PE basis out of these ones we talked about, but it has come down to 31 times, and it too is a #3 hold. Then we finished up with AMN Healthcare, ticker A as in Adam, M as in Mary, N as in Nancy. It's a #5 strong sell, as those earnings estimates are being cut and still on the decline, and it is a trap. So that's AMN Healthcare, AMN. And as always, you want to be sure to subscribe to get us. You can get us on, we're on all the platforms. We're on Spotify. We are on Apple. We are on Amazon Music. You can get us on YouTube, but only as a podcast, an audio podcast. But we have a whole podcast channel there. You can subscribe and get all of our podcasts, including ETF Spotlight. Get those good Nina Mishra podcasts. She's always covering super interesting ETFs. She just did one on quantum computing. So be sure to get hers. You can just subscribe on our YouTube channel there, and you'll get all of our audio podcasts. So go to Zach's podcast, subscribe there to get it. You can get the Market Edge podcast on our normal YouTube channel. That's under Zach's Investment Research. Put that in, subscribe over there, and then you never have to worry about finding either one because you're subscribed to all of our channels. But be sure to get us somewhere, and I'll see you again next week with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.